The bubble and the pet rock, why modern markets float on faith, not value. 1. The immortal market illusion. Look around, and it still looks perfect, doesn't it? The SANP's unstoppable. Nvidia's worth $4 trillion. Microsoft is practically its own economy. America, we're told, is invincible, the land of innovation, AI, and eternal growth. But the illusion of immortality hides a slow decay. The purchasing power of the dollar has collapsed in one lifetime. The bond market breathes only with central bank oxygen. Yet, everyone keeps saying, the market's fine. They said that in 1929. They said it in 1972. They said it in 2000. So what does that actually mean? It means optimism has replaced analysis. The market hasn't defied gravity, it's just forgotten how to fall. Footnote. Every generation believes their bubble is different. None of them are right. 2. The madness of crowds. Jeremy Grantham, the historian of bubbles, once said people are wired to love good news. Optimism sells better than caution. And he's right, no one wants to hear about risk over a cocktail. We crave comfort more than truth. Right now, retail investors are being serenaded by Wall Street sirens, ETFs, AI, diversification, and endless buy-the-dip culture. The herd is sprinting toward the cliff, terrified of missing out. The Nasdaq's trading at 49 times earnings, driven by 7 companies. Jeff Bezos is quietly cashing out $6 billion. Warren Buffett's sitting on hundreds of billions in cash. That's not optimism, that's preparation. So what does that actually mean? It means the smartest men in the room are backing toward the exit, while the crowd keeps dancing. Footnote. A party isn't over when the music stops, it's over when the smart money leaves early. 3. Mean reversion and market amnesia. Markets always come home to reality. It's not cynicism, it's math. Bob Farrell called it mean reversion. Benjamin Graham called it value. History just calls it inevitable. Every market crash tells the same story, euphoria first, humility later. 1929's Great Depression market took 29 years to recover. 1972's peak didn't heal until the 1990s. The dot-com bubble took 11 years. The Nikkei's 1989 peak? Still hasn't fully recovered 30 years later. But investors today believe this time is different. AI, they say, will save everything. Funny, that's what they said about railroads, electricity, and the internet too. They were right about the innovation, and wrong about the valuation. Footnote. Technology changes fast. Human greed doesn't. 4. The central bank safety net. The real moral hazard isn't corporate, it's monetary. Every dip since 2008 has been rescued by the Federal Reserve. The market has learned to expect bailouts like Pavlov's dogs expect dinner. Buy the dip isn't strategy anymore. It's religion. But markets that can't fall are like forests that can't burn, they look lush until the fire finally comes. If interest rates spike or the Fed loses control of yields, the blaze will be uncontrollable. The Fed can print money, yes, but not faith. Every rescue weakens the dollar a little more. So what does that actually mean? It means the sand can survive, but your currency won't. Footnote. You can't print value. You can only print excuses. 5. The overreach of power. The problem isn't just economic, it's political. When governments gain the power to save markets, they rarely stop there. The COVID era proved that. Entire populations locked down, dissent censored, and even digital payments threatened. Remember the Canadian truckers? One protest, and their cash, crypto, and accounts were frozen. That was a preview, not a one-off. Digital currencies and stablecoins make such control instant. A single click could one day erase financial dissent. Sound dramatic? So did banning gold in 1933. So did bank bail-ins in Cyprus. So did pandemic lockdowns. Until they happened. Footnote. The new frontier of power isn't physical, it's programmable. 6. The case for the pet rock. So, yes, gold. That analog pet rock everyone mocks. It doesn't yield interest. It doesn't live in the cloud. It just sits there, quietly refusing to be erased. In a world where governments can freeze accounts or seize crypto, that useless lump of metal starts to look like the last act of rebellion. Gold won't make you rich overnight, but it will make you sovereign for as long as you hold it. It's not fast, but it's private. It's not digital, but it's durable. When faith in institutions falls, tangible things rise. So what does that actually mean? It means freedom might look old-fashioned, and weigh about 400 ounces. Footnote. Sometimes the smartest move is the simplest: hold something no one else can delete. 7. The decline of trust. Governments, left or right, have lost credibility. Coalitions fracture. Promises break. Policies shift like sand. The social contract feels more like a subscription service that can be cancelled anytime. People are disillusioned not because they're paranoid, but because they're paying attention. Modernization gave us 1,000 new tools and no new wisdom. As one writer once said, we can make 1,000 pianos a day, but can't find a good piano player. Technology multiplies our reach but not our reason. Footnote. Progress is easy. Principle is hard. 8. The return to common sense. AI, crypto, tokenization, all these shiny innovations may indeed change the world. But they don't change human nature. The greed, the panic, the crowd, they're constants. And in every era, those who think critically, who hold something real, who refuse to outsource judgment to an algorithm, survive the storm. So what does that actually mean? It means autonomy beats automation. Always has, always will. Footnote. The oldest asset on Earth still beats the newest illusion in town.